All right, everyone. Welcome once again to the Exit Your Way Business Roundtable.
You got to work on that music.
The music. See, I could hear it, but I don't think everybody else can. So it's funny. So everyone, if you're listening on LinkedIn, go ahead and drop where you're listening from. Ask us questions. Go ahead and do it. If you're in the room, drop the chat in. If someone on LinkedIn wants to know how to get into Remo and interact with us, just go ahead and look under my posts and you can find it, or just go ahead and DM me or something like that, and I'll get you the link to drop in. But today I'm really excited because we're going to talk about business valuation fundamentals. We're going to ask some questions if you want to ask some questions as we go along, and we'll get this done. So if you're not familiar with the format, we do this roundtable twice a month. We do it at the first Thursday of the month. We're going to talk about a subject, not necessarily us all the time. And then on the second Thursday of the month, or the third Thursday of the month, first and third, had to remember that. The third Thursday of the month, we're going to talk about some practical applications of what we talked about. So in this case, we're going to go over some valuation situations that we've come into and some other things like that. And we're going to get a panel of people that are going to be able to talk about it. So that's going to be pretty exciting for us when we do the next one here. So without further ado, I'm going to, first of all, if I hadn't done it already, I just start right in. I want to thank everyone for coming and listening to us today. We enjoy sharing this information. And Andrew and I have just really want to let you know that. And the other thing we want to do is just get started. So the one thing that I just don't know any business owner other than an investment business owner that starts their business or gets into a business and goes, what's my value? What's the value of the business, or what kind of value to business do I want to build? Right. And that's what we really thought about this. So Andrew, before we get started, what do you think some are the real benefits of knowing the keys of your business value? If you get in your business and get started, what are some of the benefits you can see if you start knowing that early?
Sure. I think, I don't think people think about that first when they open their doors and start business. They're thinking, really they're thinking off the income statement, the cash flow, how much money's coming in, how much money's going out, how much can I keep and put in my pocket. And that really, that's value, right? That certainly is value, but it isn't what the business is worth as an asset. And I'm surprised, even to this day, I have people come to me, thinking about retirement, thinking about selling their business. It's kind of the clock's coming around. They don't know how to do it, but they don't even realize that they're sitting on an asset that has value. It doesn't even occur to them. And it happens. I swear to God, and don't realize there's a market out there to buy their business. And it's a big market.
Yeah. Yep. And it really is. And I think, when you look at this, if you, in terms of what we see helping clients as they, in the last few years, owning their business, getting them ready, getting the value to where they want, we really begin to understand if they're, the importance of knowing this and what it really allows you to do. Because if you know that this factor can adversely affect or positively affect your business value or your ability to achieve the value that you want, those things can get changed, and they don't take 20 years. They take a year maybe at the worst.
Yep, certainly can. And I think everybody kind of has a concept of value and business value because most of us have invested in the stock market.
Yeah.
Right. I mean, ultimately, you're by buying the stock, you're a part owner of the company, albeit you have very little control over it and that kind of stuff. But in a publicly traded company, you're watching that value, and they keep that scorecard every day.
Yeah.
Right. And that's the thing that really you have to translate back down to your own business value. That's a moving target. Today, we can tell you, maybe, we're going to get into how, valuation works and those basic fundamentals for a business owner. Yeah, it might be worth this today, but by the end of next week, it could be worth something completely different.
Yes. Yes.
Good or bad.
Good or bad. That's a great example. And we've talked about it before, where we've had clients and helping them towards the end of and they make decisions that adversely or positively affect the value considerably. And it really can. And great points, Andrew. So what we're going to do here is we've got some slides we're going to share. We want you to go ahead and drop, Andrew, you're going to have to check the chat because, I guess the chat will work. I got the technical thing here. I'm going to get this going here, and we'll make sure that we can see the presentation and share it appropriately. So,
yep, I'm seeing the chat too. So, good morning, Jeffrey Graham. Good to see you.
Yep.
Or not see you yet, but.
And now I gotta swap that and do this, and now I can share my screen, I believe. Now, what am I sharing? Let me try. I want to do it. No, it's still working. I just want to make sure that I apologize, people. I need to check one thing on LinkedIn here while we're doing it to make sure I'm sharing the right screen there. But
so I can get out the book on valuations
and read it.
Pretty dry subject, but we could start going. We'll give you the Reader's Digest version, but this is a good one here. This is the Bible, and what's key about this is valuing small business and professional practices.
Yeah.
Key on small. This is really, because valuing large businesses is a lot of the same fundamentals and principles, but anyways, we're not going to do that.
We're not doing that today. We're not doing that today. So
I'm a junkie on, kind of a valuation geek anyways on that.
Yep.
Stuff, so.
Yep. So we're going to share this right here, and we're going to talk about business valuation fundamentals. And really what we want to do is explain some of the key things that affect your business value the most so that you can use that going forward. So and
then we're going to go through to kind of how, valuation works or how we come to these numbers as well.
Yeah.
Understanding that, at least at the fundamental level will allow you to make good decisions.
Yep.
In your business.
Yep, that's for sure. All right. So without further ado, let's get rolling. So our goal today is to give you some actionable information. And as we go through this, you're going to see that I'm not the technical guy here. Andrew knows what's going on. So I'm the play-by-play announcer, and he is the one that's vice versa, whatever. I'm the color commentary here. So, but what we want to do today is give you some actionable information that you can use in your business to really affect the value. So we're going to get started and get rolling through here. So Andrew, let's just talk about some valuation facts, because, as people look at valuation, they often think it's just a simple multiple of the profitability.
Mm-hmm. Yeah. But, and I think a lot of people may be familiar with the rules of thumb, and they can go, my business is, worth, I want to get 1 time X revenue, as a rule of thumb. So it's worth that, or 2 times revenue, or 2 times EBITDA. They talk about these rules of thumb and those are great. Those are, rules of thumb are very useful, and it is a good way to kind of understand where you are. But at the end of the day, going through an actual valuation and using rules of thumb can be extremely different.
Yes. Because in a real world valuation, now you can go to a million websites and plug in your industry and profitability, and it'll spit out a number. And that's about what it's worth. Because in a real valuation, you're talking about things like, what is the health of your industry? What is the industry risk and stability? And then you also look at things like, how do you compare to others in your industry, and how do you compare to others that have just completed current transactions? So there's a lot of different things that you need to figure in, and your own individual business risk. And that's one of the things that a lot of people won't address in a very simple valuation, where they're just trying to give you a rule of thumb, as Andrew said. And when we were on last time, we kind of looked at the rule of thumb, right? If you have 100 people in the room and they all stick up their thumb, how different is that? So how good is your valuation going to be based on a rule of thumb? So
rule of thumbs will generally get you in a ballpark.
Yeah.
They can be used, and so they are useful.
Yeah.
But the fact is too, what is most important about business valuation is data, is the information you read, and that's the challenge. Small businesses is that in for publicly traded companies, but half of our economy is all tied into small businesses. The data is not very accessible.
Yeah.
People don't talk about it. There's confidentiality issues. They don't have to disclose. They don't have the regulations that you do in public companies. And there's benefits to that, but there's also negatives when it comes around to kind of where you're at.
Yeah. Yeah. And the interesting thing, and this is why I wanted to bring it up first, is that the reason you're doing a valuation will affect the outcome of the valuation, right? And we're going to look at some of the reasons, and it will be a different number. So there are a lot of reasons why people do them. Most people think of the common ones, and we're going to run through those real quick. So
there's more than them than you would think.
Yeah, there are a lot. If we went through the whole list of them, that's actually over probably 10 or 12 at least. So the most common one that people talk about is most probable selling price. So Andrew, talk a little bit about the most probable selling price.
Well, we sell businesses. That's what we do. And we have business owners come to us and, hey, I want to sell this business. The next question is, I don't know what is it worth?
Yeah.
And we got pretty good at this over the years, but we need to be able to provide the most probable selling price is, I look into my crystal ball here and say, look at the information that they can provide, and this is what I think your most probable selling price is. Doesn't mean this is what you're getting out of this transaction, but that's the selling price. At least it's a good starting point or a basis to work in. And so this is our common, most used valuation, at least for our standards, and also useful for any business owner just to kind of get a gauge of where they're at this time.
Yeah. And it'll use several of the valuation methods, but it won't go into the more intensive valuation methods. But it is that gauge that you want to have to make sure that you're in the right ballpark. And this is for buyers and sellers. I think we've had buyers come to us and do them and come to find out that the value that the seller wanted was double or more than or just significantly more than what they really should have been, and help them get the price to where it should be, or stop, not make a bad decision. And then also on the sale price of it, if you're leaving money on the table, you don't want to leave money on the table. And with valuation, the other thing is there's a bit of valuation that's subjective. So if you're getting ready to sell a business, one of the things that we do is we test market. We test markets our businesses with a small group of buyers that we know. And that allows us to really test market what's going on sometimes to validate that our numbers are close.
Which comes around a good point too, is valuation is really, it's based on who's the decider. Okay. So in this case, the decider is the buyer, and we can give you a most probable selling price, even a bracket of value. And this is where you're at today, but it doesn't mean anything until somebody who's willing to come up and pay that selling price. And then what the company's worth and make an offer. So, and then, in other kinds, which we'll go on to the next slide, legal proceedings, tax plannings, different decider. This might be IRS, court of law, the judge.
Yeah.
So in this case, you use different approaches.
You use different approaches, and obviously there are different ways that you can value the business within the IRS guidelines to value it appropriately, but it may not come out the same as if you were trying to sell a business. That's all I'll say there.
Yeah, and tax planning, estate planning, these are for different purposes. Like I said, the judge is the decider, but you can see very, very different values based on the market. You know, the most probable selling price and what a tax or estate planning situation is, because and these are gray areas. You know, so this is much more of a legal side of it, and you have to be able to get by the judge.
Yeah.
In the cases or the audit.
Yep.
Looking at a tax ruling and stuff like that.
And this is a good point too, Andrew, to talk about. If you're going to get a valuation for IRS or estate planning, or even one of the other ones that we have here that require IRS type involvement, don't screw around and go for the cheap price. Get somebody that's a certified valuation person that's got the designation and the insurance and everything else, that if you get taken to task on that valuation by the IRS, that you can defend it in court and they're going to be able to stand up to the numbers.
Well, that's really what it's for. I mean, you're there to back up and validate, obviously in these situations too, you're looking for less value.
Yeah. And Mark brings up a good point. He said, yes, divorce is a situation where you're going to do valuations, and
well, we're going to get there.
Yeah.
We're going to get there as well. That's for disputes, that's in the legal side.
Yep.
And you're right. Valuations then, this one, we're a little out of order, but 401, stock options, so there's legal requirements.
Yeah.
This is one of them. Stock options, if you give your employees incentive, you give them stock for incentives and stuff like that. This is just a legal requirement every year. Evaluation needs to be done on it, so that that's really to protect the employees.
Yep, it's protect the employees and make sure that you're doing what you should be, because you've designated that. Again, this is an IRS kind of thing. They're requiring that. The other thing that
you got to pay tax on it.
Yeah, you got to pay tax on it and stuff. So it's gotta be in there, right? And the ESOP is another example of where valuation is used extensively, and it requires not only valuation at the beginning. So when the ESOP buys a company, they're buying it for the appropriate price, but isn't it required annually then beyond that too?
It is. I mean, and basically these are sort of regulations that are coming in that are big companies do this every day, every quarter. They have to do their submissions. They have to go through audits and that kind of stuff. It's to protect their shareholders. And so this is now trickling down into small businesses who are using ESOPs, because you got 100 employees who are now the owners of the company. They're vulnerable. So the government wants to know if you're selling them the company for that amount of money. And basically, you're not, in an ESOP situation, you're not getting paid by the employees. They earn that out over years. They want to know. They do evaluation every year to make sure that your shareholders aren't getting screwed.
Yep. And
so
good stuff. Good stuff. And Jeff Graham brought up the triple D: death, delusion, and what's the last one? Divorce. Yeah. It's
actually 4 Ds: death, divorce, declining sales, and dissolution.
There you go. So
that's 4 ways to get out of a business.
Yeah. And I did have these kind of out of order. We talked about legal proceedings too. Divorces, man, that is one that there's actually people that, believe it or not, that's what their valuation practices revolve around, is divorce valuation. So it's kind of
and those situations, both sides are going to have valuations.
Yeah.
That's a
great point.
And so your evaluator then has to come and stand up and back up, through their experience and their resume. And we do valuations, because and I always go back. You can get people, you can get CPA firms and those kind of stuff to do valuations and such too. But I really think our benefit to that is we actually are involved in the transactions, and it goes back to, you really don't know what a company's worth until it changes hands.
Yeah.
And if you have a lot of experience doing that, and doing the valuations is just a critical path. But you're going to go in here and one side's going to be high and one side's going to be low.
Yes.
And then it's all back to the decider.
Yes.
Right?
And this is where, again, if in legal proceedings, you brought up a great point. There will be 2 valuations. And listen, if it's worth significant money, if you lose, it's well worth it to put the time in and get a more thorough valuation from someone that's going to be able to stand up in court, and you win that way.
And let's go back to most probable selling price. We're probably, and when I do that, I use probably 3 or 4 different methodologies, and I will evaluate them based on the information I receive from the seller and about the business. Everything we do, we kind of weigh those methodologies appropriately. Some of them can be weighed actually equally, but some of them are heavily weighed towards one methodology. But in an evaluation for a legal proceeding like this that's fully certified, we're probably using up to 25 different methodologies.
Yeah.
And we're going to go through that a little bit.
Yeah, we're going to go through some of those. So we got a couple questions here that I do want to address, because Con brought up a really great question. And first of all, hello, Con. Great to hear from you and everyone else. But he said, how does evaluation differ for a business like a consulting or training practice that has few physical assets where the owner is the brand compared to what we're talking about?
That's a great question.
Yeah.
That's a great question. And, yes, there again, see, I think this is somebody who's got a consulting business and doesn't really understand there is value there, right? So consulting business practices, these are cash flowing businesses, though.
Yep.
And, the historical cash flow, is the basis for the value. And then, obviously why do you buy a company? Because you want to come in because it's been cash flowing and making money for the last 10 years. And I expect that to continue. And I'm gonna participate in it, help pay for that business when I pay for it and pay for the debt service on it. And then I'm gonna own that asset at the end within a reasonable amount of time. That's where you kind of get into that value. You don't need physical assets. And while physical assets is, I think, a common misconception is that people think I have a factory with $10 million worth of equipment, the best machines, the state of the art. My company must be very valuable. But when we look at the income statement, they've been losing money for the last 2 years. So guess what the company's worth? The business is worth this, but it is worth the assets.
Yeah, it's worth the assets.
Equipment worth 50 cents on the dollar.
Yeah.
So these are goodwill kind of businesses, and when the owner is the brand, we're going to
talk about that
here, because that is a common thing that we have to deal with when we're selling that. And it's things that people should really think ahead when they go and starting the business. Slapping your name on the business, can cause some difficulties when you get down to when it's time to move the business and stuff like that. It's not impossible to sell it, but if you are the brand or you are heavily involved in the business, there's a lot of tribal knowledge. You can come to us and talk about how we can help you extract yourself from it, and you can significantly increase your value. But it's definitely a negative, and it's a risk when the owner is heavily involved.
What it does is it makes it more difficult to get the actual value. So and we're going to talk about, Mark just asked the question, when the owner is the brand, how do you determine to what extent cash flow is dependent on the owner? Well, we're going to talk about that in a little bit. So we're going to go through.
I can give a great example for this. I like to use this because, when we are involved with dental practices.
Yeah.
Dental practices, there isn't really a lot of assets. They probably lease a building and other than equipment, but they're all goodwill. I mean, people go to their dentist because they know them. They've been going to them for years. So when you do that transaction, the only value you're getting from the company is all those people that come and get their teeth done. But when they are, and the banks too are, will they fund this? But when, a new guy comes in, and you had 100, clients before, and they just switch dentists. I don't want to be with this guy. How many are we going to lose? That's the whole thing. And so, there's techniques you can use. Doesn't make the business devalue, but it makes it trickier to exit. Yeah. And typically, how they do that is they bring in their buyers in, as partners, and then, eventually there's a transition out, and also, a good portion of the price and the value is held. until there's a time has passed and we can see how much of the customer attrition there is.
Yeah.
Just a good example.
That's a great example, because it does typically draw out the time that you're going to get paid the total amount for your business if you're involved in it heavily, or it makes it more difficult to sell. Now, Con asks a question: how can existing contracts, MSAs, and client lists impact value? I'll answer that real briefly. The existing contracts, if you got contracts that someone can step into and continue on, that is the gold standard for that kind of stuff. If you've got longer term 2-year contract with somebody and you know what you're going to get paid for that, that is awesome. If you've got MSAs and you can show that, hey, every year this MSA has produced this, I've got it for 3 more years. That's another great example of what you can do for it. So
recurring revenue.
There you go. Recurring revenue. That's why Andrew was doing the recurring revenue. Yeah.
That is, that's very valuable.
Yeah.
And buyers are looking for that, and the evaluators are looking at it. However, one of the challenges of selling a business and one of the major contingencies that a buyer is, are they transferable? And so again, that's another
great point.
To do understanding it value is, but when you negotiate those contracts and that kind of stuff too, just, ask the question when your customers say, hey, what if I have to transfer this business, or what if I sell? I'm not saying you are, and I'm not saying I am, but it's good to know. And maybe even you can negotiate in a clause there that those are assumable contracts to a buyer.
That's a great point, because we got bitten in transactions before where you like a big company here, like with us with aerospace companies, you really have to look at that, because the big companies like a Boeing will make you get approval to sell your company in that contract. They'll say you can't do it without getting that approval. So that's a great point, Andrew. And Con, on those kind of things, if you can build those in where they're assumable by the new owners without approval, that's the best. So we're going to continue on. So there's a lot of other special valuation uses. So Andrew, just off the top of your head, name a few of the other ones that you run into.
Wow. Let's see, where are we going here?
With evaluate uses of evaluations, because there's like the ones, and I don't have the details of this page, but there are just a litany of the different kind of valuations that you're going to need when you have say management buyouts. So you got partner dissolutions, where you're going to have 2 partners want to get out. That it really in those situations we've really seen that's very unique, because if you're doing an inside sale only to other people in the company, there's a discount that's associated with the value because you can't sell it outside. There's just a lot of different ones where you run into them, where someone like Andrew that's doing the valuation, or other valuators, they really need to consider that, because just like whether I'm looking at it for taxes or selling a business, they're different. It'll be different in those situations as well.
And they sort of fall into that legal entity, but the other uses are applying loans, business loans, applying even for personal loans, funding your business. Obviously, the banks are in a lot of cases are requiring these. SBA loans require.
Yep.
They're not very detailed loans, but
yep. And
buyouts,
I had that. Yep. And then just the fair market value opinion and those kind of things are used for a myriad of things, like we talked about as well. So, so this is where it gets interesting now, because people talked about this and the fair market value of the business. IRS actually has a definition for this, Andrew. Talk about the premise of value. It's the first statement on evaluation, and I don't think anybody really reads it.
Do you have it there? I mean, I know it, but I don't have it.
I can't see the notes in this, but it's the one that talks about the willing buyer and seller.
Yeah, I should memorize it, but yeah, it's when a business fair market value. The definition of it is, the legal definition of it is, when a business is willing to change hands between a buyer and a seller when the buyer is not compelled to do so. I think that's sort of a abbreviated version of that too. And that's very carefully worded legally, but it is very true. I mean, they don't have to buy the business. That's where the market, that's the supply and demand factors, but it is an awfully strange market rather than supply and demand where you can kind of get in a sort of an auction type of thing in a typical economic cycle. But, at a certain point, business transactions have to make economic sense.
Yep.
Which they do, but they also, but you could also get irrational pricing.
Yeah.
And it happens all the time, especially in the tech space.
Yeah.
And that's probably the one everybody understands is most common, or in startups.
Yeah.
Where they're really focused the value and the transactions based on future value.
Yeah.
And so anyways, we go through some of the assumptions on the premise of value here. And I think we'll just go through.
We'll go through some of the assumptions here, but
right?
The one thing that I wanted to bring up with this slide is just because your valuation says your business is worth $100 million, it doesn't mean that you can find someone that will pay $100 million.
That's exactly
this is the only reason why I put this slide in here, because you can have a tremendously profitable business that no one will give you near the value for because of a lot of other things. So,
and I think too, people can look at that too. So, Amazon is one of the most valuable companies in the world, but they aren't making near the cash that some of their peers are making in the Fortune 500. And it's been like that for years. They're not a cash cow, but everybody understands their value there. It's more in the future, and it's dominating that market, and they basically unlimited potential. So that's an interesting aspect of value, though. So.
Yep, it is. Just because it's worth something doesn't mean you'll get it, and that's why we did that. So when we look at the valuation methods in themselves, and a valuation is typically a combination of methods that come up with different numbers that are blended. Correct, Andrew?
Correct. Yeah, we talked about those methodologies, right? So when we're doing most probable selling price, like I might use 4 or 5 of the ones that are most relevant. And they all fall under 3 different categories: the asset approach, the income approach. Under 2 major, the asset approach and the income approach, and all the other methodologies kind of fall either into one or the other.
Yeah. So explain the asset approach and why we do the asset approach method. Use that asset approach method in a valuation, Andrew.
Well, the asset approach, as it suggests, is looking at the assets of the business, including the goodwill and that kind of stuff. Whereas the income approach is, looking at, it's really about the numbers, the ability in the historical revenue stream that's created, which is basically the underlying value of the business. And then the real kicker is the future potential revenue of the company.
Yeah. So the asset approach too you'd use that in a valuation, though, is basically to set the liquidation value, correct?
Yeah. That is always a starting point.
Yeah.
Liquidation value, orderly liquidation value is something we need to do in a business valuation, even though we may not weigh it in the value.
Yes.
Liquidation value is just, say, if I shut down today and sold it off, it's not being sold on the market. And what would it be worth? And in the case of what Con was talking about, that's going to be very low because you're just selling off physical assets. And if you don't have them, that's fine. But, and the reason we need to do this too, because the business may be worth more being liquidated than it is on the market to sell it. The market buys the revenue stream or the profitability or the potential profitability of the company. And a really good example of this is, and people see it all the time, is furniture retailers who have a lot of assets. They may have warehouses full of furniture that you can put a number on. And as we know, that's a highly competitive business. They have a lot of overhead. They have facilities all over the place, and they're losing money. So if they're losing money on the market value, they're worth, they're only making, if they're doing 20 million in sales and making 100,000 a year, and so that's a 7x. They may be only worth $1 million, but they have 15 million in inventory. So that's where that trigger switches, and it's we don't say in that case it makes more sense to liquidate, and that's when you have liquidation sales. That's how they exit those businesses. They're orderly liquidations.
That's an awesome example, Andrew, because that's a great thing where the asset approach gives you a better the value you really should use, because and we're going to talk about the income approach and some of the things there. There's a bunch of different methods under the income approach, but generally give us the idea of what we're going to use with the income approach.
So, they're looking at historical income and over the years, usually on an annual basis. And, you're going to develop multiples of this. And that's where your value comes from. So in most probable selling price, I'm looking at that as a basis from the buyer, what perspective he has. You go into that business, say, yeah, it's been making, $400,000 or $500,000 a year consistently over the last 5 years. And then we're going to come to a multiple of that and make that assumption.
Yep.
And what's different here is this is a numbers, approach as opposed to the market approach. The market, it's going to look here at the market approach. They're going to look at your business and how it's done up into this point.
Yeah.
The income approach is going to look forward. Okay. So, you're going to get more value off of it if you have been growing on a consistent basis, say 20% year over year, because then you can project that future income into the future. And then you would say, okay, what will I pay for this? It's growing at 20%. If we assume that happens for 5 more years, what do I pay for it today? And then we discount that back.
Yeah.
To that, and the buyers will do that, which will give you sometimes a higher number than just where it is today based on what it's done in the past.
Yeah, that's a great point. And that whole discount rate calculation it takes someone that's done the valuations, just understands, can figure in the risk of your industry, your business, and everything else to do that. But it is valuable because if your company is growing, you can actually, your value will typically value higher. So Great point. So you just talked about it a bit too. So, and we've got 2 slides on the market approach because this is such a great indicator. So Andrew, talk a bit about the market approach to valuing a business.
Well, what a buyer would be willing to pay, and this is the one that's most relevant to us, since we're involved in a transaction and helping a client. And the best way we can do this is really understand what the market will bear. And with that, you need data.
Right here. This is an example of the kind of data that we get is you get market comps. You're looking at the sizes, and this is detailed data that you can get as a valuation person. You can pay the subscription rates and get the detailed data. It's not waving a wand. I mean, look at how they've used statistics to give you the percentiles, the medians, all the kind of stuff on this data on private transactions. And go ahead, Andrew.
And this is hard to get. This is the hard part. I mean, you can get these. It's the formulas and the numbers that they're generating and all that kind of stuff are coming. The same ones that they use for publicly traded companies and everything else. But where do you get this information from? Every time I do a transaction, I belong to these organizations. So brokers, investment bankers have been submitting this data for years, and they go out and do the research. But as you can see in here, we've narrowed this down into a certain type of business, and we zeroed in on a certain size range of the business. And so there was 9 comps here, 9 transactions that we can look at, very similar. And we can go into even more detail than this, but by entering in the balance sheets and the terms of the deal on closing, we can analyze. This is just valuable, really clutch information for really understanding. Because I think everybody too understands. I'm selling my house because my neighbor's house last year sold for that, and that one up the street sold for that, and we're about the same size and same shape. So it does sort of help us, get in that ballpark. Although you will see that you have to really look at this closely, because this isn't apples and oranges. And
Yeah.
businesses are way different.
It is, and you have to look at it carefully, but this really allows you to see what the market's doing on a business. And that's where a rule of thumb approach just does not give you enough detail to really go, okay, because this is where I always say, if someone walks into your business today and you get two numbers, and they get two numbers from you, they say, okay, you're about this big in revenue and this much in profitability, and they tell you with certainty that's what your business is worth, they haven't looked into it.
Yeah, and this happens also. This happens all the time. I mean, when I see this with clients, my competitor, or I've been, Jim up the road. We're both in manufacturing. We're both doing about 20 million a year. He just sold his company for $50 million. Therefore, my company must be worth about $50 million. But if we looked at Jim's company, he was $50 million with $5 million in profit and owned the real estate, and was leasing it back to himself. And the other guy down the street coming to me, I want $50 million for my company, but he's making $500,000, rents his space, and still has top line of $50 million. So what do we think it's worth, right?
Yeah.
Not as much.
Yep. Not as much. There could be technology, there could be IP, there's all kinds of things that affects this too, beyond the numbers here as well. So let's quick roll into this, because we're getting near the end, but these business risk adjustments. Now, this is something that Con talked about earlier, if the owner is the business and other things like this. Now, when you're doing an in-depth valuation, the business risk adjustment talks to many things. And yeah, I did put this in there on purpose, Mark, because it will literally blow up a deal like this, or sabotage your chances to get that value. Like we said, you can have $100 million company. And we had an example. We helped somebody a couple of years ago. Their business was worth, 30, 40 million. They were getting offers at 15, 12 to 15. And it was because of these risks. So it's real world things that will affect your value. And the first one is management depth. So talk about this a little bit, Andrew, and how you can adjust this, or how this affects the valuation.
Well, I think too, this goes back to Con's question as well. When the owner isn't heavily involved in the business, I mean, it's one thing to be branding it with your name, but if you're there and you're working, you're still, even at 65 years old and you're near retirement, you're still working 70 hours a week. That's a risk. Management depth, professional management. Think about the buyer. The buyers coming in, they're really investors. And a lot of the better buyers, the ones who pay more money, are investor buyers. Not necessarily, they're not buying a job. They're not coming to buy into working 80 hours a week, because nobody wants to do that. They want to use their money because they're paying investing, and they want to see that money work. And that personnel, the key personnel, these are not risk factors. They can be risk factors, but they can also be assets.
Yeah. If the key personnel are too important to the success of the business, if you have one person, that's the reason why. And this is owner or an employee. If you have one person, that's the key, and they hold some knowledge that you just can't find someplace else, this will negatively affect your business. If there's
these are all factors that are, these are common in small business, small, medium businesses. Tribal knowledge, things not written down, no set processes. It's in the owner's head, or it's in the key employee's heads. Those are the things that will drive value down. Or they just spook buyers. So, that's where you're at with that.
Yeah. And we talked about this before, and I'm going to address the question Mark asked, and I hit the wrong button. Oh, well, we're going to have to get off at 9. How do you assess it? It is a matter of doing the in-depth interviews with the businesses to understand how they run. That's how you do this, Mark. And there's a whole matrix that you use to be able to do this. So again,
what we do is, how do you assess it is the same way a buyer would.
Yep.
Right. So I'm going to make an offer on your company. That's all good, because we said all this. We said you had a great management team. We said, all these great assets that you're buying with the business. They make an offer, but then you get into diligence. So that's, we do the assessment the same way the buyer does. They have their legal review, they financial review, they interview all the employees, and you got to get by all those landmines in order to get a deal done.
Yep.
And so we do it the same way.
Yep.
And then we put value on it.
Yep. So the industry stability obviously plays in, like we talked about. Customer, supplier, product diversity. If you're too concentrated in one product, one customer, one supplier, that's going to help or hurt you depending on what you're doing. You want to diverse on those things. And then really, as it showed up there in our market approach, is what's your net profit ratio compared to others in the industry? That's going to be another big. If you're lower, higher, it's going to really negatively or positively affect you from the others in the industry.
A big portion of that too is benchmarking.
Yep.
It's another factor that we do in, and I think that's right there. You can do this. You can benchmark your business against the industry. And why do you want to do that? Because the buyers are going to do it. Valuators do it all the time. Hey, what is our net income revenue percentage and margins? Benchmarking is, you can look at your peers, companies similar size. You can get a whole bunch of metrics to see where you're out of line with the industry or you're ahead of the industry, which we would emphasize those in selling the business.
Yep.
In most cases, and it will help you make decisions too on how you need to restructure your business and your strategy to get back within the benchmarks. Because if they identify something that's out of whack in a benchmark study, that's a risk.
Yep.
And that that's gonna spook a buyer as well.
Yep. And it's great. Benchmarking is a great thing. And that was the end of our slides. And what I'm going to do is I'm going to quit sharing my screen right now. And I want to talk about a couple things real quickly here that I think that we, I'm going to shut this down real quick and shut our presentation down so I can actually see what's going on live. Then I want to thank, first of all, thanks for Jennifer Gordon for commenting on LinkedIn, but a couple things, Andrew, that I wanted to cover before we finish. And I want to, at 8:55, I want us to stop presenting and go back to the tables for at least a few minutes, but it's really important. If you talked about benchmarking, if someone gets a good value of their business early and they track this like the financials, like their monthly financials, this is one thing that we've really seen is beneficial for our clients in what we do. And actually, when you're going, hey, I'm at 5 million, I want to be worth 10 million. Explain how you've seen that help companies, just the use of the proactive use of valuation.
Yeah. And benchmarking is an aspect of it too, and everything else, but it's gonna, if your labor, and I think we just went through a company that did this too, that paid a lot of bonus out to their employees, really, really good to their employees. But when you circled back and looked at their profitability percentage over their peers was way lower. This is a technical engineering company.
Mm-hmm.
Solving one problem was labor problem. I mean, they kept labor and they had long tenured employees and loyal employees, but their percentage margins way down. Identifies a problem in the cost. And, buyer, would you be willing to take that on, if he's paying 20% over market on his labor? But that's the thought process they have, right? So you got to think about that when you make those business decisions, right? And it's all good to want to share your company, but at the end of the day, it affects your asset.
Yeah.
Perhaps the retirement.
I think you said one thing there that I've really seen it help business owners with is when you're looking at your monthly financials and you go, okay, I made 100,000, $1 million, 10 million this month, whatever the net income number is. And you look at the line below it. And when we help them, and that's the value, what did my value do this month based on my last 12 months? This is where we really get your mindset begins to change. And I see Troy's on here today, which is awesome because Troy gets to help owners after they've exited and manage its wealth. And you really, that number, if that number is not big enough to make the owner happy, and Troy says, hey, you're going to be good after this, that really helps them to get from I'm enamored with the fact that I'm making $1 million a month to I know this is going to be giving me the value I need or not. And that's the long term.
I think that number, if you're looking at that value, and that's sort of a point in time, but if you really start to understand that number and see how it moves, you can have a big impact on it. And Troy will tell you too, when it's time to cash out that most probable selling price, how we're going to use that money in a different way so that you're not living off a business anymore.
Yep. Good stuff. Well, it's getting close to the top of the hour. And, as we said before, we are stopping this thing at 9 a.m. our time because we want everyone to be able to get back to work. So we're dropping off LinkedIn Live here right now. And then we are going to go back to the tables for a couple minutes of conversation. And then everybody's back out to kick it for the day.